My first guest today is Jeff Levin, co-head of North America Private Credit at Morgan Stanley and chair of the Direct Lending Investment Committee. With $20 billion in assets under management, Jeff oversees the firm's private credit investment strategy for senior secured loans and junior capital investments in North America. Welcome, Jeff. It's great to see you today.
Thank you for having me.
It's good to be with you. And, I do want to go back to a little bit of your career history. You started at Morgan Stanley, you then went to the Carlyle Group, you returned back to Morgan Stanley. But what's interesting is that you are one of the co-founders of the private credit business in Morgan Stanley. So what do you see back then as an opportunity to launch that at Morgan Stanley, which is a bank, by the way, sometimes competing with private credit companies?
So Morgan Stanley's actually been in alternative investing for well over 30 years. We got into private credit in 2009. A few of us were on the leveraged finance side of the business, on the sell side of the firm within the investment bank. The market's dislocated in the GFC, and to take advantage of that market dislocation, we started the private credit business within our investment management division. And so we raised the capital for our first fund in 2009 and started investing it in 2010. So we've really been in the business for about 14 or 15 years.
Right, and so that was a big opportunity, of course, then to step in post-GFC. But you fast forward to today, and Morgan Stanley Private Credit is a great franchise. And at the same time, there's quite a few others that are pursuing private credit strategies. So what differentiates Morgan Stanley in this space?
The two most important facets of the business and strategy as it relates to direct lending is origination and due diligence. And within our direct lending team within the US, we have about 70 people, a meaningful portion of which are originating deals. And that team is covering about 400 private equity firms, which is our primary source of deal flow. That team, though, does work in partnership with the broader Morgan Stanley investment banking ecosystem, where we have hundreds of bankers and thousands of clients, corporates, and private equity firms. So we think that synthetically, we're really getting the benefit within our business of hundreds of people sourcing deals and thousands of clients that can source deal flow into our business, so we can see more, be more selective, ultimately generate better risk return. And then the diligence side of it, but we'll also leverage the Morgan Stanley resources, which could be equity research analysts or fixed income analysts, industry bankers that cover certain sectors, their clients that are C-suite executives, could be economists at the firm, political insights, and so on and so forth. And so there's a lot of intellectual capital and data within Morgan Stanley that we really leverage and monetize through that diligence process.
And when I think about private credit, I think when you were first starting that at 2009, it was a minuscule asset class. Today it's about $1.7 trillion in private credit assets under management, but there's a number of sectors that fit within that. There's direct lending, there's mezzanine, there's others. So what part of private credit are you focused on?
We have $25 billion of capital, $20 billion of which is for direct lending, which is really U.S. sponsor finance. So these are businesses in the U.S. that are owned by private equity firms, and we typically lend at the top of the capital structure, so first lien senior secured loans. So think of us really as the bank with no one ahead of us. So we have a first lien claim on the assets and the equity of these businesses. Then the other $5 billion of capital that we have is investing in sponsored and non-sponsored deals up and down the capital structure. So there could be first lien that's priced wide to the direct lending market, or it could be second lien or mezzanine or preferred equity.
I saw you mention that you're really looking for down the fairway, high quality returns for your investors. So what does this mean in terms of the return profile you're looking for and the types of companies you do deals with?
The types of businesses that we look for are businesses that operate in sectors that are really non-cyclical. So for example, we'll avoid retail, restaurants, energy companies. We focus on businesses that generate really predictable cash flow streams, have strong management teams, and these businesses generally are really well diversified themselves in terms of diverse customers, diverse suppliers. And within that side of the business, we're really focused on lending money to companies that we have extraordinarily high conviction of getting our money back, providing a very stable NAV and dividend yield for our investors.
But I guess my question to you is, what happens when the Fed, maybe eventually, will actually cut rates? What happens to the return profile of private credit, and how much of the illiquidity premium should investors expect to earn?
Sure. So the illiquidity premium, going back a few decades, has generally ranged anywhere between 150 to 300 basis points above the liquid credit comparable, which would be the broadly syndicated loan market. And the spreads on deals right now range anywhere typically between 475 basis points to 550 basis points over SOFR. But I think irrespective of the market environment, somewhere between 150 and 300 basis point premium to the public credit markets is generally what investors should expect from the direct lending first lien product.
So what you see today is about that. So that's fair pricing relative to the expectations.
Yeah, look, I think like any market, certain vintage years are wider than others.
So, but you also brought up the broadly syndicated loan market. And so I do want to talk about that because it seems like in 2022, it was really hard to get a publicly traded leveraged loan, but now that's not the case. And the issuance of lev loans has picked up and CLOs are back as well. So what does this mean for the opportunity set for private credit? You know, tactically speaking, you know, is it a little bit more difficult to be a private credit investor?
The technical backdrop, which is very favorable for U.S. direct lending, is the fact that the banks don't really do this. So banks, due to regulatory issues, don't lend to middle market companies where the loans don't trade. And so that backdrop means that all that deal flow, which is typically dominated by the private equity ecosystem, comes to private credit managers, managers like ourselves. And the U.S. middle market is absolutely enormous. And so the part of the market that has access to the syndicated loan market is actually a small subset of the opportunity set for private credit, because most middle market companies in the U.S. never have access to the syndicated loan market.
You know, let's go back to the beginning. And, you know, you've been in private credit space again since the start of 2009. And I imagine you've seen quite the evolution of it. So what has changed in private credit that's most noticeable to you since then?
The scale of the asset class has evolved dramatically. I would compare it to the private equity market, where the private equity market grew dramatically over the last 25 years, and the number of publicly traded companies has been reduced because private equity ownership has become so prevalent. I think the same dynamic has been evolving in the private credit market, where we've seen private credit managers manage far more capital than we did, call it 15 years ago. And so the private credit managers like ourselves can now offer a scaled direct lending product to a large business, provide $1 billion, $2 billion, $3 billion, or even larger loan, and not just close a transaction, but importantly provide growth capital as well. So I do think over time, private credit will continue to grow further and further up market, while always having the opportunity set for the core middle market that doesn't have access to the syndicated loan market.
Right. And one place where private credit is growing quite a bit is within the private wealth channel. And so my last question for you is a little bit about the misconceptions maybe a private wealth investor may have about private credit. And I'll share one that I heard recently while I was on the road. Isn't the volatility profile of private credit lower because private credit doesn't get valued as often as the publicly traded counterparts? What do you say to that? And what do you say generally to a private wealth investor?
The asset class has provided a much more stable NAV in return experience, to your point, than public credit. The reality is, if you look at the data over a 20 or 30 year period, what you'd find is that the default rates are actually lower and the recovery rates are higher than the public credit space. There's 150 to 300 basis point spread premium as well. So investors are getting paid more, I would argue, for taking less risk. So this is not a riskier asset class than public credit. We're getting paid a premium to that asset class because of the illiquidity of the product.
So it's not just the less frequent marks, but it's actually a higher quality profile of some of the private credit transactions. That's the reason for less volatility. Jeff, thanks so much. Thanks for breaking down that question as well as many others about private credit that I know a lot of our viewers had. And thank you also for highlighting what differentiates the Morgan Stanley private credit franchise. Thanks, Jeff, for joining us today.
Thank you for having me.